Thank you, Mark, for being here and doing this. CPP is well known as a global investor with a focus on the long term. Can you talk a little bit about why long-term investing is so important to what CPP is trying to do?
Yeah, sure. So our mandate is super long-term. Our responsibility is to look after the money that is going to be needed for retirement security for 20 million Canadians. And we have measured, sustainability is measured over a 75-year period by the chief actuary. So inherently we think long-term. We're thinking about people's retirement. We're thinking multi-generational. We're a forever fund, and we have to be there for multiple generations of people's retirement. And we measured over 75 years. So it's really important to us that value is not created in the next quarter or the next year, but is created in the long term. And so when we look at long-term investing, we're convinced that research has shown that companies that think about long-term and manage themselves for the long term create more value. Their revenue grows more over the longer term. They invest more in R&D. They employ more people over time. So overall, they create more economic value, more value for the economy.
Now, what are some of the challenges as you go abroad and try to find investment opportunities that are long-term? What are some of the challenges you run into, and how do you strive to overcome them?
We often find, and actually, funnily enough, it's more North America and Europe to some extent than it is in some other markets. But we find that management are under enormous pressure for short-term performance. And FCLT Global's done a lot of research on this, and there's lots of evidence that managers will and CFOs will make decisions which we think are dumb in the long term, which will not create incremental value. They'll forego creating incremental value purely for the next quarter's earnings or the next year's earnings. That's a challenge. So in fact, funnily enough, when we go further abroad, if we go into some of the emerging markets, we recently collaborated on some research in China. We find the management teams are under less pressure there because, to some extent, they're owned more by management themselves. They're owned more by founders, and they're not pushed by short-term public market investors to the same extent that people in this market in the US are, or in Europe.
Thank you for mentioning some of FCLT's research. One of the other pieces of research which CPPIB has been very involved in is helping to think through what a good long-term investment mandate would look like between an asset owner and an asset manager. Yeah. Can you talk a little bit about how you think about your mandates as an institutional investor, and how some of that work may have influenced some of the thinking that you are doing internally at CPPIB? Yeah,
this is an important part of the chain that we've looked at, FCLT has looked at, that seems to be not quite right. So we have asset owners that, like us, many asset owners want value created over the long term, but the asset managers end up getting measured over short-term periods, and therefore, they are then pushed to take short-term behavior in their underlying companies. And so that top part of the chain between the asset owner and asset manager is really important to get right and fixed. So it's something that we've been focused on ourselves to make sure our house is in order, and working with FCLT Global on publishing the research that was published last year on what are best practices, and they can involve a number of things. It can involve fee structures. So the fee structures are incent investment managers to think long term. So the various incentives, so fees might be deferred for lockup periods. There may be incentives for loyalty. If we're in a manager for a longer period of time, we can get a lower fee over time. There are things where we can be very clear up front about what we expect from a manager in terms of, for example, the style that we expect from them. And if there's style drift, then we may take action. And it can be things like lockups themselves. The fact that we are the money that we have doesn't necessarily need immediate liquidity, so we can take 2, 3, 4, 5-year lockups on money, which can then give much more ability for the asset manager to manage longer term positions underneath that. And so there's a whole bunch of things there. I think there were 10 tools that we put in that research, which we collaborated on. And I think if asset managers and asset owners read those and could articulate those up front, we think it's a good idea. We just ran a session to talk about it. And one of the big idea that came out of it, one of the big ideas was for a letter, that asset owners should write a letter to the funds they're investing in saying, these are the things that we expect from you. And we don't expect performance to be, we don't expect you to outperform every quarter, or even every year. So we're going to expect periods of underperformance, and that's not the reason why we'd redeem. If it's just a period of underperformance, that's understandable. But we do expect long-term performance, and that's what we're going to pay you for.
Well, that is a wonderful set of very actionable and practical pieces of advice. Anything else you would say to a manager, either an investment manager or a company manager, who is trying to make a transition to be more long-term? What would you advise them? What suggestions would you make to them?
I'd say, again, if it's an investment manager, I'd say have a really clear understanding with your asset owner what the asset owner wants. And generally, the asset owner is going to want long-term value creation, and then you can have a much better understanding, and then put it in place: the plumbing, the mechanics, the documents, and everything else that will create that. And in some cases, maybe you can't for various, whether there's government procurement issues or other things, but at least you can have a letter that says, we have an understanding. I mean, one of the funds that one of the asset owners we were talking with. Said, they've had funds for 30 years, but they have contracts in place which give them, they can pull out of in a second, and there's a disconnect there. So even if they're required legally to have, immediate liquidity, at least they can reassure an asset, a fund manager by saying, look, we have funds for 30 years. Our average fund holding is 15 years. So, yeah, okay, we have short-term liquidity requirement, but what we expect is to hold for the long term.
Great. Well, Mark, thank you very much, and thank you for all your leadership in FCLT Global.
Thank you.
Thank you.